Okay, good morning, everybody. Thank you very much for joining us this morning. For those of you that haven't spoken to me before, my name's Darren. I'm one of the international sales managers here at Novia Global. So this morning we're hosting the latest in our series of Pulse webinars. We get really good feedback on these, and we get good good sign-up numbers, and today is no exception. So thank you very much to everybody that has joined us, or indeed anybody that's watching after the event, which you are able to do. We will try and make these pertinent and relevant to you, and I think today's webinar will be no exception. In fact, I was only speaking to an advisor this morning about cash. Client, obviously interest rates are now much higher than they have been for many years, and so clients are attracted to that safe haven of cash. But with inflation running riot, is that the right thing to be doing? So it's our pleasure to be joined by James, who's a senior investment manager at Brooks Macdonald. James is going to be talking to us this morning about investing in volatile markets, and perhaps looking a little bit at cash versus investments and how that's played out historically. As always, we will take your questions. So if you do have any questions, please do submit them as the webinar is going on, and we'll have a small Q&A session at the end. I think we'll crack on, and without further ado, I'll hand over to James.
Thank you very much, Darren, and good morning, everyone, and welcome to the Brooks Macdonald International Market Update. Just before we start, I thought I'd give you a bit about myself. I joined Brooks Macdonald in 2021, providing advice to clients, advisors, and trustees. I'm level 6 qualified and I've got 17 years of experience in the financial industry, and I also partake in the investment and research committees. I've worked at a number of multinational banks throughout my career, and it's my pleasure today to be speaking with you. Just to let you know, I'm going to turn off my camera so you can focus on the slides. Okay, so here's a bit about Brooks Macdonald. We were formed in 1991 and listed on the alternative investment market in 2005. As of the end of last year, we had 16.2 billion in assets under management, and that's growing. We have over 85 investment managers who are part of a team of over 400 staff in 15 offices in the UK and the Crown dependencies. I'm at Brooks Macdonald International, and this is where we have a truly international reach with clients worldwide and offices based in Jersey, Guernsey, and the Isle of Man. Next slide, please. Making sense of volatile markets. On this graph, it really does show to pay attention of how markets perform over a longer period. And we've certainly had a very interesting 18 months. However, markets do come through both turbulent and uncertain times. And looking at this graph, it shows us some of the larger market events since 1970. We've got the dot-com bubble bursting of 2000, the global financial crisis in 2008, COVID-19, and last year, who can forget that, with war, high inflation, and economies recovering from COVID. Ultimately, investment managers need to remain active during these volatile times in order to generate alpha. We must also keep in mind and remind our clients that are invested for the long term, but highly important is reassuring them during some more difficult times to maintain contact. Next, it's often talked about by clients that the industry that stock markets will give you an average return of 8 to 10%. But I always look at this slide and it poses an interesting question. How accurate is that? If we go back to 1928, nearly 100 years, how many single years were returns between 8 and 10%? The answer is 1. And in actual fact, 70% of returns have seen double-digit gains or losses. Investing in equities will rarely give you anything close to the average return. They're volatile by nature, and we will have turbulent years. But looking back at this graph over 100 years, it isn't unusual, and even 2022 was volatile. What is pleasing to see here is they're far more green than red, which points to positive returns over the longer term. And on the next slide, another important question that clients ask me is, well, don't all asset markets act the same? The answer is very rarely. This shows every asset class going back to 2008 and how they performed in that calendar year. The best performing asset classes are at the top, the worst at the bottom. Let's look at 2022 on the far right, first of all. Every asset class from commodity was negative apart from commodities and cash. Cash delivered 3.5%, which was the first positive return in many years. However, taking into account inflation, the real rate of return was negative -5 to -6%. Due to the energy crisis, commodities performed at 33.7%. However, this asset class is high risk, and no diversified portfolio manager would invest purely in this sector. In fact, prior to 2022, many investors steered away from this sector unless it was purely renewable energy. You can see between 2012 and 2016, it was the worst performing sector. Cash. We can see on this graph, on this chart rather, that has been historically low since the global financial crisis. And if we take into account inflation, cash has actually been delivering negative real returns for many years, even when inflation was at normal ranges of between 2 to 3%. In addition, this shows us the importance of having a diversified portfolio where every asset class can bring different strengths at different times, including cash. Any diversified portfolio should have an element of cash depending on the risk profile. Okay, so cash versus investing. There's a lot of discussion at the moment about the higher interest rates available in the bank versus investing. But let's look at returns and inflation over the 11 years. Here we've got a number of factors to consider. I've used our pure equity portfolio to give you an idea of how equities have performed. And then I've also used our benchmark ARC. Now, this is a benchmark that collates the performance of over 100 other investment managers, so we can see how we're performing. Equities would have performed at 142% over the past 11 years, and our benchmark 95%. That's taking into account management fees as well. Inflation's 37% return on that, but cash is only giving you 7%. So not too bad on the equity side, but what is really important is what's in a client's pocket at the end of the day. And on the next slide, it shows us the real rates of return. Whilst returns on the previous slide show good growth outside of cash, it's very important to note that although cash rates are now more attractive, if you fix into a savings account, that you can get between 4 and 6% now, depending on the rate, on the term you want to look at, you're locking into a loss with inflation currently at 7.9% as of yesterday in the UK. This reminds us that with investing, you have the potential for growth and income at a potentially higher rate than on cash. It's no means guaranteed. However, since 2012, the returns you would have received in our equity portfolio, the real return, including your charges and inflation, 77% uplift. Our benchmark, 41%. But if you left that cash in the bank, it would now be worth 22% less than 11 years ago. And that's even taking into account recent high interest rates over the past year to 18 months. Okay, I thought it'd be good to give you a bit of a market update today as well. And we've got 3 key messages really to deliver. Economic growth is generally proving quite resilient, more resilient than we thought. And we've upgraded our projections. Corporate earnings results have been solid and the outlook has been positive. Inflation is still sticky. Better growth is meaning that inflation is falling slower, but it is falling. Rate cuts are still expected to come, but more likely in 2024 or potentially 2025. We're still very positive on equities, however, bonds are becoming very attractive once again. On the next slide, we're going to look at a bit more about the yields that are available. And in the investment world, the term TINA has been used for many years, which stands for there is no alternative. Post-financial crisis, equities were the place people invested in for return, with fixed income providing very little other than some defense in volatile markets. Our toolkit has now changed and has expanded, and there are opportunities in fixed income. Bonds are providing much higher returns, and as you can see from both graphs, which show the US on the left and the UK on the right, the gap has narrowed between the yield on equities and on the yield on bonds. So fixed income is back and it's providing a good level of income. And the base rates has really helped with that. The UK is currently 5%. There were talks before yesterday it was going to be 6.5% by the end of the year. That's now looking at about 6%. But it's predicted to remain at that level for circa 2 years. The US is at 5.25%, potentially going to 5.75% by the end of the year, and expected to come down a little in 2024. We're really benefiting from this in portfolios through the fixed income because of the higher rates that are available. The returns are currently between 5 and 7%, which marks a dramatic return for fixed income over the past 10 years. Okay, what about equities? Well, equities are now looking more attractive, and the price earning ratio is looking about average at 16.2 times at the moment. Again, this is a departure from pre-2022, when this ratio was much higher, and points out there are lots of opportunities for growth within equities, and it could be an excellent opportunity for those who are wanting to invest. Here, this is over the 5 years. But on the next slide, I really wanted to have a look over the longer term. This graph is very positive. It shows us every dot in a calendar year, and that's approximately 100 years. On the x-axis along the bottom is the price earnings ratio for each year, and the y-axis shows the annualized return over the next 10 years. The line on the graph is the current price earnings ratio or thereabouts. This might look very complicated. However, it is showing us at no point in history have markets had this valuation and you haven't made at least 5% annualized in the next 10 years. So the next few years could be really excellent for investing. And again, an opportunity for those clients who want to add additional funds or they're looking to start their investment moving. But within equities, it's really important that you have balance. And we maintain balance between equities in the value and growth sectors. Prior to 2021, the growth sector was a major driver in the performance of equities. The growth sector would be such stocks, tech, health, North American stocks. And in 2022, we saw a major shift from growth to more of a balance between the two areas of growth and value. Your value will be very much your international stocks, your UK stocks, and some Far East. We've adjusted the equity allocations accordingly, as I mentioned. And in 2023, we have seen some major growth stocks rally. But interestingly, we've seen this widen into other areas of the market. So investor confidence, as I mentioned before, is definitely coming back. Ultimately, for those who are invested, are looking to invest, as long as they're patient and they can expect a little bit of volatility as we move forward for the rest of the year, they will be rewarded as we recover from 2022. But one element that's important to that, and you will see on the next slide, is that your portfolio is positioned correctly. And let's look at our investment process at Brooks Macdonald International and Brooks Macdonald, and there are 3 key areas we look at. First of all, the top-down perspective. This is our central house view, our big picture view of the world, and it's decided by our London-based Asset Allocation Committee, where 9 senior investment leaders from our business will come together to formulate a top view of what asset classes, that's your equities and bonds, what sectors, maybe international and North America, what geographical areas, Japan or emerging markets, and what currencies we like or do not like, and we set out a framework for our asset allocation. We then move down to the investment managers, the bottom-up perspective. Every investment manager has a research sector they are part of, and on a monthly basis, we will meet within these sectors to decide and populate a buy list for this sector. This provides multi-channels of expertise. I'm part of the Far East Asian Emerging Market team, and my 16 colleagues in Jersey will all be part of a different sector. Finally, the Brooks Macdonald Investment Management team. We all come together on a monthly basis to use a top-down asset allocation and the bottom-up buy list approach to construct a multi-asset portfolios for our international clients. So the investment process is very much a team approach, and we're utilizing the knowledge and expertise of over 85 investment managers from across the overall business. How does this all translate into the management of your portfolios? Well, there's three main asset allocations. Fixed income. We're keeping duration very low at 4 years. This results in a defensive positioning in an environment where rates are still in flux, as low duration assets are less sensitive to changes in interest rates. We've moved very recently actually to a 50-50 balance between high quality credit and government debt. We have a preference for passive funds or tracker funds within our fixed income area, as in a volatile bond market like last year, it allows us to quickly move our exposure around. Then there's equities, of course. Again, we're ensuring balance. But what does that mean? It's threefold. In asset allocation, the split between the equity and bonds, we're sitting in the middle of your portfolio's risk-adjusted allocation. Geographically, we separate regions. And finally, we're also balanced between growth and value. This gives us defense, but also means we'll remain open to benefit from the recovering economy. We've also increased our allocation to Europe this year, where the market experienced a tough 2022, but fared much better in expectations, and price-wise, valuations are very attractive. It's been the valuation of the market over the longer term has been cheap, allowing for good returns. In addition to this, China is a major importer of European luxury goods, which is experiencing a recovery, albeit slower than expected, and the Chinese consumers are coming back to these brands. And then last of all, we focus on alternatives. As it's clear volatility is not over, the alternative allocation acts like a volatility dampener by adding other investments that are not correlated with bonds or equities. This increases your diversification within portfolios and reduces overall instability. And that all translates to a portfolio. And as you can see, I've given an example of one of our balanced portfolios where equities were sitting at 62%, fixed income we're interested at 20%, alternatives and structures at 8%, and then some cash, as mentioned before, you should always hold. And that gives you your diversified balanced portfolio. Thanks for taking time to listen. It's been quite high level, but if you have any queries, please get in touch with your usual financial advisor about Brooks Macdonald. I'd welcome any questions.
That's great, James. Thank you very much indeed for that. That was an interesting listen. I think one of the key points, I suppose, that I picked up on, based on what I said during the intro, was the important reminder that whilst cash appears, much more attractive at the moment than it has done in recent years, you are still effectively, I think, locking in a loss was the phrase that you used, and I think that's perhaps something we all need to bear in mind when clients are coming to us and suggesting that that they'd like that safe haven of cash with everything that's going on. Interesting here that there's positive outlook. The metrics are looking good in terms of equity investments and what you said about investor confidence starting to return. So a question from me, James, actually, if that's okay, before I move to some of the questions that we've had come through on the Q&A, would be, there are any, you mentioned equities are looking potentially positive. Are there any specific regions that you're particularly positive about?
Yeah, so as I mentioned, we're particularly positive about Europe at the moment, and we expanded into Europe considerably. Within our portfolios, we see it as a very good opportunity. A lot of the multinationals there are, giving good results. I'd say, North America, you have those larger growth stocks and companies that really have rallied this year, but that's spread across the rest of the market. So again, there are opportunities. That the key I would say again is very, very important, is making sure you're diversified across the portfolios, because depending on how the economies continue to reduce inflation will dictate a little bit for the rest of the year how the market performs, and any shocks could cause a bit of volatility. So again, you need to have that level of diversification, especially across countries, and we wouldn't necessarily invest in one key country area specifically.
Sure, thank you. And I think that you probably partly answered one of the questions that we've had come through there anyway. Yeah, one of the questions we've had is, thanks for talking through some interesting topics. Given current market volatility, what do you think are some key strategies that investors can employ to protect their portfolios and minimize risks? So obviously you've covered diversification in your answer there. Is there anything sort of outside of that or even above that you think is worth mentioning too?
I think again, making sure your asset allocation is right. So diversification within your assets your asset class is important, but making sure you've got the right setup for your risk profile as well. So for example, we've got it on the screen. So we've got the balanced portfolio, for someone who is a little bit nervous and wants to be a bit defensive, then you're positioned correctly. You've got your fixed interest, you've got your equities aren't too high there. I would suggest if they want a more of a defensive approach, then they should look at a lower, potentially looking at a lower risk profile to dampen down volatility, which you would normally, typically use fixed interest for.
Great. Another question we've had is, you have covered this to an extent already, but do you have any other recommendations for balancing between cash holdings and investment positions to optimize returns whilst ensuring sufficient liquidity?
That's a hard one, because as I said, while inflation's high, and although you might be locking in on it, keeping your cash in a savings account at 4 and 5%, if inflation stays in, for example, the UK, if it stays at 7.9% for the rest of the year, unlikely, but if it did, you're locking in at a loss. What I would say is perhaps, you need to make sure you've always got that cash buffer and a cash element to your overall wealth portfolio. I would potentially keep it, your cash fluid, so that you're able to invest when you feel there's opportunity and when you feel that you're comfortable to do so, but leaving you enough, of a safety blanket for anything you might require those funds for. So I think we are recovering from what was a very volatile year last year, and it was history making. But actually, the opportunities for investors now, moving forward over the next few years, is very good. So I think for those clients who are thinking, why should I invest? I can get 5% on the cash. Yes, you can, and absolutely, and that's your safe, return. But you're locking in that inflation, but you're also you're not benefiting when the markets really rally. So to have cash in the sidelines to be able to invest as markets do improve and clients feel comfortable, it is vitally important.
Thanks, James. Right, we've got two more, so we're just going to put you on the spot twice more. Why isn't inflation coming down as quickly in Europe and the UK as America?
Okay, so there's a number of reasons behind this. Firstly, the UK and Europe, they were much later to start increasing rates in the States. So inflation has taken longer to peak in Europe and the UK. Also, both the UK and Europe were much less aggressive than the Fed in the States, much less aggressive. So that's a key factor. I think the energy crisis that we saw last year, that was much more prevalent in the UK and Europe, which was a big driver of inflation. And what we also have to remember, especially for the UK specific, the UK imports a lot of things, so energy, food, materials, whereas the US and Europe to an extent are much more self-sufficient. They're able to produce the goods. They're able to produce their own energy. Okay, Europe was a little behind that with the issues last year, but the United States is a very self-sufficient country.
Great, thank you. And then final one then that we've had through is, and I think we've to some degree covered this already, but I've just touched on it again. So how have investments fared longer term against inflation?
Okay, this is one that's come up a few times with clients and advising me recently. And a term that's always, or time that's always bandied about, and there certainly has been, is the 1970s and the high inflation environment then. So I've done a bit of research into this, for clients. And if we went back to the 70s and we invested in the US, for example, your investments would have kept up with inflation and cash in the US. In the UK, it would have slipped slightly, but by the 80s, both markets were outperforming cash and inflation, and this is where you would have seen the real larger return benefits. Much better. And if we bring that to modern day, the differences are huge. I think it's very important to note that in the 70s and 80s, whilst inflation was stubborn as well, like it has been, it was a very different environment. There was high unemployment. There were strikes going on. The cost of living was vastly outpacing what it is now. Whereas now we're continuing to see such low employment across Europe, the UK, and the United States, and that's a pattern that hasn't really stopped. It's creeped up a little bit, but nowhere near to anything that we saw in the 70s, 80s, or even the financial crisis time.
Yeah, that's great. Thank you very much indeed, James. So, well, that concludes all our questions. So, so I guess that all leaves me just to say thank you very much indeed to everyone that's joined us this morning, and thank you for your continued support of these webinars. Yeah, thanks for listening in. Thanks for submitting your questions. As always, a copy of the video and the slides will be available to everybody after the webinar, so we'll get those out to you. And obviously, if you do have any questions, please do get in contact with the relevant sales manager, Novia Global, and we can obviously put you in touch with the relevant person at Brooks Macdonald to help you out if you have any queries about their portfolios. So yeah, thank you very much once again. Pleasure to have your company this morning, and yeah, we'll hopefully see you for the next webinar very soon.
Thank you very much.
Thank you.